Stop looking at your phone. Stop checking the COMEX ticker. Because while you're watching silver trade at $74 in New York, something extraordinary is happening 5,000 miles away in Shanghai. The physical silver market in China has completely disconnected from the West. Street prices in major Chinese cities are hitting $99 per ounce. That's a $25 gap. And this isn't a spread. This is a broken market. I'm going to explain why this $25 vacuum is draining Western vaults dry, why the paper price you see on your screen is a ghost, and why the real price of silver is being set in Asia right now. This is the story of how the East just took control of the global silver market while the West was sleeping. Let me be clear about what we're seeing. In New York, the COMEX spot price shows $74.59. That's a futures contract. A paper promise. It assumes infinite supply exists. But walk into a manufacturing district in Shenzhen today. Try to buy immediate delivery of industrial-grade silver. You'll pay close to $100. Not 74. 100. Why does this matter? Because this proves the inventory is gone. When a price rises 30% above the global benchmark, it signals a localized famine. China is starving for silver. And because they're starving, they'll pay any price to keep factory lines running. Think about the mechanics here. If you're a global bullion dealer right now, you face a simple choice. Sell 1 bar of silver in New York for $74. Or put that same bar on a plane to Shanghai and sell it for $99. Shipping and insurance costs maybe 50 cents. Your profit? $24.50. This is what traders call risk-free arbitrage. It's an infinite money glitch. So what's happening right now across the Western Hemisphere? Every available bar in London, Zurich, and New York is being allocated for export. The vaults are being swept clean. There's a giant sucking sound coming from the East. This is the $25 vacuum in action. As metal leaves the West, local supply drops towards zero. When supply hits zero, price must rise. It has to rise until it becomes too expensive to ship to China. It has to rise until the gap closes. This means the U.S. price has a mathematical destiny. Not speculation. Not hope. Mathematics. Water finds its level. And right now, the level is 100. For 50 years, the COMEX set the global price. If silver dropped in New York, it dropped everywhere. That relationship just died. China is now the price setter. New York is the price taker. Why? Because China consumes the metal. New York trades paper promises. The consumer always sets the final price. If Samsung and BYD are paying $100, then silver is worth $100. It doesn't matter what a bank says on a computer screen. Look at what happened today. Silver jumped $3.40. Nearly 5% in a single session. Why? Because traders are realizing that $71 was a gift. They're understanding that if they don't buy now, the metal will be gone. They're chasing the Chinese price. This is the catch-up trade beginning. Now let's talk about what you're actually seeing when you check prices on dealer websites. Go right now to any major bullion dealer in the US. Look at premiums on a silver eagle. Spot shows 74. But that eagle? It's selling for $90 or $95. The physical market in America is already pricing in the China move. Only the paper market is lagging. This confirms the disconnect is purely financial. Banks are using algorithms to suppress the paper price while the physical world transacts at much higher levels. This tension cannot last. Eventually, paper breaks. Shorts capitulate. Price gaps up overnight to meet reality. Why is China paying $100? Is this a bubble? No. This is inelastic demand. China controls the global solar panel industry. They have production targets to meet before year-end. If a factory manager runs out of silver paste, his entire operation shuts down. The cost of shutting down a gigafactory runs millions of dollars per day. So if silver jumps to 100, he pays it without hesitation. The cost of the silver is microscopic compared to the cost of failure. This is why industrial demand sets the floor. Investors might sell at 100 to take profit. Industry buys at 100 to survive. The floor keeps rising because the desperation keeps rising. We also need to understand the currency dimension. Chinese citizens are watching their property market collapse. They're seeing stock market volatility. They're rushing into gold and silver to protect savings. This retail wave in China is layering on top of industrial panic. It's a dual-engine rocket. The West cannot suppress a market being bought by a billion people. We're outnumbered, and we're out of metal. Let me show you the magnitude of this arbitrage opportunity. New York trades at a 30% discount to Shanghai. This is the biggest discount in modern history. It creates a massive opportunity for Western investors. You can buy silver in the US for 74, knowing the true value in the physical market is already 100. You're buying dollars for 74 cents. But this window is closing fast. Arbitrage bots are working around the clock. Ships are loading. Inventory is moving. Once vaults in New York are empty, price will reset overnight. We could see a limit-up move taking us straight to 80, then 85. The market is trying to find equilibrium. And equilibrium is much, much higher. Now we need to talk about the banks. The entities that are short this market. Right now they're staring at screens showing $100 in Shanghai and 74 in New York. And they're realizing they're on the wrong side of the most violent trade in history. Usually banks love arbitrage. If they see a $5 gap between markets, they step in. Buy the cheap one, sell the expensive one, pocket the difference. But today, the banks are paralyzed. Why? Because to capture arbitrage, you need physical metal. You cannot ship a short contract to China. You have to ship bars. And the banks don't have the bars. They leased them out, sold them, rehypothecated them multiple times. The vaults in London, which used to overflow with Western stockpiles, are running on fumes. So banks cannot close the gap. Instead, the gap is closing them. Every time a trader in Shanghai bids price up to 100, it acts like a margin call on New York short sellers. They're bleeding millions per hour. This forces a strategy change. For decades, the strategy was cap and contain. Sell paper to suppress price. Today, the strategy is survive and exit. We're seeing signs of massive short covering. Banks aren't adding new shorts to stop the rally. They're buying back old shorts to escape. Look at open interest data. It's dropping. When price goes up and open interest drops, it means shorts are leaving. They're admitting defeat. This removes the ceiling. Without the heavy hand of banks suppressing price, silver floats to its natural level. And China has shown us that natural level is 100. Let's discuss what traders call the widowmaker. In finance, a widowmaker is a trade that looks smart but destroys everyone who touches it. Right now, shorting silver is the ultimate widowmaker. Why would anyone stay short when physical markets trade at a 30% premium? It's financial suicide. The only entities still short are those too big to exit without spiking price to 200. They're trapped in a burning theater with a door the size of a mouse hole. Their only hope is demand collapse. But demand is inelastic. Samsung isn't stopping production. Tesla isn't halting battery lines. The Chinese antis aren't stopping their buying. Demand is locked in. This creates a powder keg. If one major short holder panics, if they buy back everything at market price to save themselves, we get a flash melt-up. We saw a preview Monday. We could see a day where silver moves $10 or $20 just because one bank decided survival beats loyalty. Now look at the calendar. Tomorrow is December 31st, New Year's Eve, the final trading day of 2025. This is the most critical closing bell of the year. Why? Bonuses. Portfolio managers get paid based on performance as of December 31st. If they're long silver, they want price closing at absolute highs. They want to mark books at 75 or 80. This creates massive incentive for window dressing. Funds will be buying tomorrow, painting the tape, pushing price up into the close to maximize fees and reputation. This institutional buying pressure acts as tailwind. The dip is unlikely tomorrow. Big money is incentivized to buy, not sell. Remember the tax selling pressure? That ends tomorrow. Once the tax year closes, selling pressure evaporates. You have funds pushing price up and sellers disappearing. That's the recipe for breakout. We could easily see silver challenge 77 by the time the ball drops in Times Square. Let's talk about dealer behavior. Usually if you sell coins to a dealer, they pay spot minus $1. Today, many dealers offer spot plus 2 or spot plus 5. They're desperate for inventory, calling customers asking if they want to sell. This is reverse squeeze. Dealers becoming buyers because they've depleted stock and refiners are closed. When buyback price exceeds spot price, spot becomes irrelevant. It proves physical markets are tighter than paper markets admit. This creates a floor. Why would you sell a contract on COMEX for 74 when local dealers pay 78 for real metal? You wouldn't. Sellers leave COMEX. They go to physical markets. This drains paper market liquidity, making it even more volatile to the upside. We also need to consider currency dynamics. China manages yuan value. By letting silver rise to 100 in China, they're effectively devaluing yuan against silver. But they're doing it strategically. They're signaling to citizens, get out of cash. When government signals inflation, people listen. We're seeing a rush into hard assets in Asia that dwarfs anything in the West. Chinese retail buyers, the famous Annies, are buying silver bars en masse. This retail wave is unstoppable. 1 billion people moving savings into metal. The West cannot suppress a market bought by 1 billion people. Let's look at technical damage to bears. The chart is broken for short sellers. They drew resistance lines at $30. Broken. Lines at 50. Broken. Lines at 70. Broken. Every technical indicator they used to justify selling has failed. RSI overbought. Price goes higher. Bollinger Bands stretched. Price goes higher. This forces technical traders to flip. Bears become bulls. They stop shorting resistance and start buying support. This adds fuel. When skeptics capitulate and join the rally, that's when vertical moves happen. We're seeing bear conversion right now. As we head into the final day of the year, setup is perfect. East drives price. West is trapped. Industry hoards. Banks cover. Calendar forces funds to chase. All cylinders firing. But we need to look beyond tomorrow. The real money is looking at January 2nd. That's the first trading day of 2026. That's when rules change. Global pension funds manage roughly $50 trillion. Their allocation to commodities sits near historic lows, maybe 1%. Their allocation to silver is effectively zero. But in 2025, silver was the best performing major asset. Bonds lost money. Real estate stagnated. Tech stocks were volatile. Silver went vertical. Investment committees at pension funds are holding meetings. They need inflation protection. They need hard assets. They need to buy the winner. If they move just 0.1% of capital into silver, that's $50 billion. $50 billion of new buying power entering in January. Now compare that to market size. Entire annual mine production of silver is worth roughly $25 billion at current prices. See the mismatch? Pension funds are trying to buy 2 years of global production in the first week of January. They're pushing an elephant through a keyhole. The only way the elephant fits is if the keyhole gets bigger. Price must expand to accommodate capital. This is why the move to 100 isn't just possible. It's necessary. Price has to rise to a level where 50 billion buys a meaningful stake. At 74, 50 billion buys everything. At 200, it buys a reasonable position. This buying is automatic. Mandated. Doesn't care about charts. Doesn't care about RSI. It just executes. And it's buying into a market where China already vacuumed up the float. Unstoppable force meeting empty object. The Silver Institute releases supply-demand data annually. For 4 years, they've reported deficits. Market ignored them. Said above-ground stocks would cover shortfalls. In 2026, that narrative dies. We expect major deficit revisions. Why? They finally have to account for military consumption, AI energy demand from Microsoft and Google data centers, and admit recycling supply isn't coming back. When official data catches up to reality, it removes the last bearish argument. Perma-bears who said supply would flood markets will be silenced. There is no supply flood coming. This realization triggers waves of analyst upgrades. Goldman raises targets. Citi raises targets. They chase price higher to stay relevant. Their upgrades bring in retail herds. Now we need to discuss black swan risks for 2026. The world is unstable. Conflict in the Middle East. Tension around Taiwan. Debt ceiling crisis in Washington. Any one of these events could trigger flight to safety. In the past, safety meant U.S. Treasury bonds. But in a debt crisis, bonds are the risk. Capital flees to neutral reserve assets. Gold and silver. If war breaks out, oil spikes. When oil spikes, mining costs rise. The floor for silver rises. If a currency fails, gold spikes. When gold spikes, silver follows. Silver is the call option on chaos. Looking at the geopolitical map, probability of chaos is high. China knows this. That's why they're paying 100 per ounce. They're not overpaying. They're paying the war premium. Securing metal before sea lanes potentially close. The West sleeps. The East prepares. The price difference, the arbitrage gap, is the cost of Western complacency. Let's talk about the psychology of 3 digits. $100. It's a magical number. When an asset crosses 100, perception changes. At 99, it feels like a commodity. At 100, it feels like a store of value. It gains legitimacy, attracts wealthy savers who didn't want to mess with cheap coins. Now silver becomes a prestige asset. This brings in family offices, high net worth individuals. They want to own the asset that crossed the century mark. They want bars worth 20,000, not 5,000. Density of value matters to the wealthy. As silver gets more expensive, it becomes more practical for large wealth storage, not less. We also see unit bias for small investors. At 100, a 1-ounce coin feels expensive to average buyers. So markets adapt. Fractional silver becomes standard. Half-ounce coins, quarter-ounce rounds, gram bars. This happened with gold. Nobody casually buys an ounce of gold anymore. They buy grams. When silver switches to gram pricing models, it unlocks new demographics. People with $20 can still participate. This sustains retail demand even at high prices. Markets evolve to keep squeeze momentum. Let's pivot to physical delivery numbers on COMEX. We're entering delivery month. Traders who bought January contracts are about to request metal. Usually they roll contracts or settle cash. But with Shanghai Premium at $25, why settle cash at $74? You'd be throwing money away. If you take delivery, you can sell to China for 100. Make 25 per ounce instantly. The incentive to stand for delivery is highest in history. Every rational actor must take metal. This means the drain on COMEX vaults in January will be catastrophic. They could lose 10 million, 20 million ounces in a single month. If that happens, registered inventory hits zero. Game ends. Banks know this. That's why they're panic buying now, trying to get metal before delivery notices go out, front-running their own clients. It's a race to the bottom of vaults. And vaults are shallow. As we look at the chart today at 74.59, don't see it as a price. See it as a countdown clock. Every cent it rises is a tick closer to the moment vaults run dry. Every cent closes the window for paper shorts to escape. We're counting down to default. A soft default where paper settles for paper and metal settles for a king's ransom. We need to prepare for regulatory narrative. When silver hits 100, governments will blame you. They'll call it speculation. Talk about market stability. Might raise margin requirements again. Launch investigations into hoarding. This is noise. The sound of government losing control of currency. Don't let them gaslight you. You're not the problem. 36 trillion in debt is the problem. Silver is the smoke detector. Debt is the fire. You don't smash smoke detectors to put out fires. But they'll try. Be ready. Ignore it. Let me summarize the January setup. Pension funds entering. Industrial restocking continuing. COMEX delivery cycle intensifying. Shanghai arbitrage persisting. Geopolitical hedging accelerating. 5 forces pushing the same direction. There's no counterforce. The only counterforce was bank shorts. And banks are covering. Sellers have left the building. Nobody remains to say no to higher prices. This is why the vacuum exists. The path of least resistance is vertical.